All right, let's dive into a really fascinating financial puzzle. It's a story that starts with something very strange happening in Japan, but trust me, the shockwaves could end up affecting all of us, no matter where we are in the world. So let's get right into it. So we're going to kick things off with a real head-scratcher. Japan's central bank just made a move it hasn't made in 17 years, and the way the markets reacted, well, it seems to fly in the face of everything we know about economics.
So here's the puzzle. Japan is finally raising its interest rates. Now, Economics 101 tells you that should make their currency, the yen, stronger. But the exact opposite is happening. The yen is getting weaker. So why is the market betting against Japan?
And this right here just lays out the contradiction perfectly. I mean, look, on the left you've got the textbook case. Interest rates go up, the currency gets stronger. Simple, right? But then you look at what's actually happening in Japan on the right. Rates go up, and the yen's value goes down. This is the mystery we've got to solve.
And here's the answer. It's because investors, well, they just don't believe the Bank of Japan can actually follow through. I mean, with a national debt that's a staggering 240% of its entire economy, the market is basically saying there's no way you can raise rates high enough to matter without completely crushing your own economy. They're trapped.
But here's the thing. This isn't just a story about Japan. To really get what's at stake here, we've got to pull back and look at the bigger picture. Because for decades, Japan has been quietly acting as a fuel source for the entire global economy.
And it all boils down to this thing called the yen carry trade. For years, it's been the world's best-kept secret. Basically, a source of free money. Big-time investors could borrow Japanese yen for next to nothing, like almost 0% interest, and then go buy stuff that paid way more, like US stocks or bonds. This has been a massive, massive fire hose of cash for global market.
And this quote just nails it. As Japan starts to raise its rates, that free money spigot gets turned off. It's not going to be a sudden crash, no. It's more like someone is slowly, carefully removing one of the main support pillars that's been holding up the entire global market for 3 decades. And when you do that, the whole structure starts to feel a lot more wobbly.
And that brings us to the absolute core of what we're talking about today. See, Japan's problem isn't some isolated issue. Japan and the United States are walking down the exact same path. They're both staring down a mountain of debt that's tying their hands. The only difference is, Japan is just a little further down the road.
I mean, just look at the parallels here. It's uncanny. Japan has this insane debt-to-GDP ratio, and what's the symptom? Its bond market is freaking out. The US has this eye-watering absolute debt number, and what's happening? It's having trouble finding people to buy its bonds. And the response? In both cases, the government is having to step in and buy its own debt. It's the same problem with the same playbook.
Okay, now for the part that's really going to make you sit up. When you look at what America is doing right now to handle its own debt problem, it is eerily familiar. It's like they found Japan's playbook from 10 years ago and are following it step by step. So first, just remember how Japan got here. They started with massive money printing, quantitative easing, or QE, to keep their borrowing costs down. Then, their own central bank became the biggest buyer of government debt, but eventually, inflation came roaring back and it forced their hand. They had no choice but to pull back.
Now look at the US today. The Treasury is buying back its own bonds. The Fed is buying up short-term debt. They're even starting to use new names for QE, like reserve management. Every single one of these moves is a page out of Japan's book. The US is just at an earlier chapter of the same story.
So, if Japan's liquidity pillar is starting to crumble and the US is right behind it, what does that mean for all of us? What happens next? Are we all just headed for one giant spectacular crash?
Yeah, this is the big question, right? Is the whole thing about to come crashing down like it did in 2008?
Well, the answer seems to be no. And this is a really crucial point. We shouldn't be bracing for one single massive event. What we're actually entering is a completely new environment, a new era for how markets are going to behave.
And this new reality is all about constant stress. So think less about one giant earthquake and more about continuous aftershocks. We're going to see way more volatility, more scary moments where the cash seems to just dry up, and much shorter cycles of boom and bust. And because the system is going to be so fragile, governments and central banks will have to keep jumping in to patch things up.
Okay, so this leads us to the final and maybe the most important piece of this whole puzzle. When governments get this deep into debt, what's their end game? What's the only real way out?
There's a strategy, and it's called financial repression. Now, that sounds super technical, but the idea is actually pretty simple.
The government deliberately holds interest rates below the rate of inflation. So if inflation is 5%, they keep rates at, say, 3%. That means the real value of their debt is shrinking every single year. They are slowly and quietly inflating away their massive debt pile. And once you understand that, a lot of other weird things in the market suddenly start to make perfect sense. If you know that government bonds are basically designed to lose you money after you account for inflation, well, it's only logical that you'd start looking for somewhere else to put your savings.
And this is the key takeaway. The big move we're seeing into assets like gold isn't being driven by a bunch of people panicking. It's a cold, calculated, and perfectly rational decision. It's investors logically moving their money away from government debt or sovereign risk because that debt is no longer a safe place to store your wealth.
And all of this leaves us with one final massive question. As countries like Japan and the US continue down this path, and as governments intervene more and more to keep the system afloat, what does a safe asset even mean anymore? The very definition is changing right before our eyes. And that's the real lesson from Japan's strange puzzle. Thanks for tuning in.